Right, the markets for now holding, but not with that kind of interest and enthusiasm as we saw the morning open session. If you look at the Nifty now, it's actually coming under a bit of strain. Anil Rego is with us for some fundamental ideas and some thoughts on the market. Anil, thanks for joining in. So, the traders are still saying it's stuck between a very, very tight range, but with this whole oil issue that's been flaring up, do you think this is a real, fresh risk to the market? Or do you think it's one of those things that will also pass?
Sure, I do expect the oil stuff to actually boil over. I don't think the crisis will, last in Libya for a very long time. Once that happens, it happened in the case, after the Egypt crisis, blew over, I do expect oil to cool off a bit. So I'm not seeing, that is a major risk. I think my concern would be if some of this actually ends up spreading to other countries there, and countries like Bahrain and any other countries in the Middle East there. So whether it's a one-time or a short-term problem or something which is continuing and across a larger spectrum there. So definitely I think oil will boil over, and I think at this time I would believe one can be mildly bullish. The index has gone above the 200-day moving average that I said, we can keep as a bit of a stop loss there. So this is a time one can probably start buying large cap stocks, fundamentally strong. It's not yet time to get into the mid caps at this point of time. I think one needs to see continued strength in the index, and then, probably one could go and put your money into mid caps there.
Anil, good morning. How about avoiding a bell curve strategy, and how about just putting 90% of your money in State Bank of India bond or Government of India bond, or one of these heavily almost risk-free instruments, and then taking 10% and going for the whack, which means finding a nice technical chart and just taking a hit. So this way 90% of your money is conserved. Worst case, you'll lose 10% of your portfolio, but then go for it. Why conservative? Why Tata Motors? Just go for whatever is running.
Cal's
your
Refinery.
Thoughts on it? Cal's Refinery. No, not Cal's Refinery. I don't have a chart on that one. But, by and large, anything which is a solid chart. I'm just wondering if a portfolio strategy like that may work.
Sure, but yeah, I wouldn't do 90% into bonds. Okay, I won't go so extreme. Yes, definitely. I think the bond market is also looking attractive from a different standpoint. I would look for bonds which are traded bonds. So I would, yes, look at SBI, which is traded on the index, and there it gives me opportunity that I may just make some non-linear returns post March, which I do expect some bit of the liquidity issues typically bunch up in March. So April should be a little better off there. So yes, some part of it may actually give you some decent returns out there if interest rates actually do fall. And in worst case, you could just keep it for a longer period of time. Anyways, I don't see, how you're going to lose significant money if you hold it for, 6 months or so. So yes, that is something that one can do for a conservative trader there. But I would not do it for 90%.
Okay, Anil, just hold that thought. Anil, quick comments with you. So what is it that you are willing to put in that portfolio? We're discussing, how much you should be in debt and how much in equity. But if you're building some kind of an equity portfolio as of now, what all should you be putting in it?
Sure, I think a couple of stocks that I would look at right now. One is maybe start off with my favorite on the pharma side. Go for one of the largest there, Dr. Reddy's. We like it because some bit of approvals have also come in. I think they've got a good product pipeline, a lot of generics, coming up for renewal, etc. So I think that Dr. Reddy's is definitely a stock to look at. Something like 1845 is a target, maybe of about 12 months. The other one from a safety standpoint, again, I'm looking at is HDFC Limited. Again, one of the more conservative organizations there, also on housing. So you don't have some of the other issues in terms of the infrastructure and other exposures there. So core housing, HDFC also has done very well in interest rate in environments where interest rates are high. So because it has the pricing power versus most of them. So something like 760 in terms of a price target on HDFC out there. One mid-cap stock, Dish TV, is something that we like. Of course, it has gone up a little bit today, but definitely, I think keeping in mind, the World Cup euphoria out there, it has been good for the cable operators, and I definitely think that Dish TV should, being the leader, will gain from there. Also, some bit of move towards HD TV, so that will also give some bit of a premium positioning there. So Dish TV is also probably a mid-cap stock that we like, which is some bit from a consumption play and with a specific event trigger out there.
All right, just one last stock, Union Bank of India, which we were discussing right now. 350 is the resistance, but this is a range stock. Can we just get a one-year chart? Since perhaps late November, it's been in a range of around, let's say, 310 to 360. So, but if it can break that 350 resistance, then it's got a resistance at 380. But it needs to get out of this small channel range.
Okay, completely out of time, so we'll have to wrap it up on that note. Market's really cooling off now, just about 10 points higher on the Nifty. So much for 5600. Seems like it'll have to wait at least for the next couple of hours. We'll keep tracking the action. Also thank Anil for being with us at this point. Anil, thank you for taking all the time as always. That's where we have to call it quits and we'll head out. But you've got Talking Funds coming up next.